Financial responsibility is usually taught as a sorting exercise. You take every loan you own and drop it into one of two buckets. The standard rule is simple. A mortgage or a student loan is good debt because it buys an asset. A credit card or a payday loan is bad debt because it buys a depreciating item or a good time. Millions of people follow this exact advice. They never miss a payment, they stay within their budget, and yet they are quietly getting poorer every year. This strategy contains a fatal flaw. It categorizes debt based on what you bought, completely ignoring the mathematical mechanics of the loan itself. Judging a debt by the purchase is a dangerous illusion. Whether a loan builds wealth or drains it has almost nothing to do with what you bought, and everything to do with a single number most borrowers never calculate. Beneath the surface labels, a credit card and a mortgage are identical instruments. The math inside the machine is the same regardless of the logo on the bill. Debt has one definition. Someone hands you money today, and you agree to return it later, plus a mandatory fee for the privilege. That fee is the interest rate. It is the sole variable inside the machine that dictates how the debt affects your net worth. If the item you purchased is irrelevant, what is the actual metric that decides if a loan makes you richer or poorer? To build wealth, you have to abandon the psychological view of money and adopt a mathematical one centered on a single threshold. This is the crossover line. A debt's impact is determined by comparing its interest rate against the return that same money could earn if you invested it elsewhere. Take a typical credit card balance. The average American carrying a balance pays roughly 21.5% in interest, a rate that sits far above the standard market return. By carrying that balance, the borrower guarantees themselves a 21.5% loss every year. It is a mathematical drain on their wealth that no amount of discipline can outrun. Flipping the perspective reveals the opportunity. Paying off a 21.5% debt captures a guaranteed tax-free return of 21.5% on every dollar used. Compare that to the stock market. A 10% return is considered excellent, yet it remains risky and the government takes a cut of the gains. For the average person, erasing high-interest debt is the highest-yielding, lowest-risk investment available on Earth. The profit is simply disguised as a bill. The math changes when the interest rate sits below the crossover line, like a 6.5% 30-year mortgage. If your invested cash earns 10%, while the debt only costs 6.5%, the debt generates wealth through the spread. You are borrowing cheap to earn more. This exact arbitrage engine is the primary wealth-building secret of the ultra-rich. The strategy is often called buy, borrow, die. The wealthy buy assets that grow in value, then borrow against those assets at low rates to get cash without selling or paying taxes. Their money continues compounding above the line, while their debt stays below it. Billionaires are not using a different tool. They simply understand which way the lever is pointed. A middle-class mortgage uses the same mathematical principle as a billionaire stock portfolio. Forget good and bad categories. Your new mental model is a vertical list of your debts, ordered strictly by interest rate. Place every loan on this list and draw a horizontal line at the 6 to 8% mark. This is your personal crossover line. Aggressively clear everything sitting above that line. Credit cards and personal loans are high-yield investments. Attack them from the highest rate down. Once you reach debts below the line, stop. Pay minimums on cheap mortgages or student loans, and divert extra dollars into the market. Debt is not a reflection of your character or a label on a purchase. It is a mathematical lever. Financial power comes from knowing which way to point it.